Hello, Bruce. Can you hear me? We're live. Can you do the intro now? Sorry, we're
Hi,
live.
Jessica. Are you talking to me?
Yes, we're live. You can do the intro.
Okay, you're kind of muffled. So I think I'm hearing you say you want me to do the intro, which is fine.
Yes, yes, yes.
Great.
Hello, Bruce. We're live now. Let's welcome the audience.
Good day. Have a feeling you folks have had a long day, but you're going to be ending, I hope, with some really meaty information about how you folks are really contributing to share price performance and value creation in your organizations, and how you in your profession can actually make a real contribution. And to share this, we have three people who have a really unique perspective on this. Dr. Solange Charras, who many in the human resources field know, not only because she herself was for decades a human resources practitioner, but she really has been one of the leading people in human resources, almost going back. You're not quite Dave Ulrich in terms of time, Solange, but you really do go back with Dave in really advocating for a strategic and systematic approach to value creation through people. And we're going to talk more about that. And then we're really fortunate to have Bart Houlihan, and he is one of the co-founders of the enormous B Lab movement, which is now worldwide. And I know you no longer work there, Bart. He's head or a partner of Irrational Capital, and he's going to be sharing with you research that is, I think, going to be music to the ears of almost anybody in human resources who feels that, wait a minute, what I'm doing really does create value. And finally, we have another leader in this whole movement of value creation through people, Martin Whitaker. He's CEO of Just Capital. And it's an organization, coincidentally, founded by a very wealthy hedge fund person named Paul Tudor Jones. Why is that? Because he recognized that value is created through people and not from them. So Martin is going to share with us the results of his work demonstrating the tremendous value you folks create in human resources and how you can profit from it. But I'm going to start from Solange first, with Solange, I'm sorry. Solange, again, based on your background in human resources for so many years, and also your early leadership in human capital analytics and understanding tangible value creation through people, how well do you think the human resources field has really adopted that? Is it still early stage? Or I know your university, Columbia, teaches it. Are we beginning to see a real movement toward a focus on value creation?
Yes, thank you. Hi, Bruce and Bart and Martin. I'm delighted to be in this forum with the two of you, and thank you, Bruce, for moderating. It's a hot topic. This whole migration of human capital from a subjective to an objective, from a qualitative to a quantitative field is probably the hottest topic today. And that shift isn't a nice to have, it's a have to have. This shift about human capital analytics and value creation through human capital is an existential imperative for HR. I don't know how to create more urgency in the topic, and Bart is going to show you why this is so important. We had a big shift back in 2020 when the SEC reclassified human capital as an investment in an intangible asset, not just an expense. So HR can no longer operate as a cost center. It has to prove that there is a direct link between what we invest in people and how that supports a sustainable bottom line performance.
Solange, I'm going to stop you there because they're going to get right back to you on that in just a few minutes. So hold that thought. Bart, I think the research that you folks have done at Irrational Capital could fill up this whole session, as is, of course, Solange's and Martin's work. But I think it's really important for people to hear about it. So could you please explain the work that you folks have done at Irrational Capital and how it relates to everybody in the enormous Hacking HR community.
Absolutely. And thanks for having me, everyone. And Bruce, good to see you. Solange, Martin, good to be here with you guys. So Irrational Capital is an investment research firm with a very simple investment hypothesis. They believe that companies that treat their people well will outperform in the equity markets. And they set out to find that connection. And using proprietary data and public data, coupled with the world-renowned social science of a gentleman named Dan Ariely out of Duke University, they indeed found a connection. And Bruce, it wasn't just this casual connection. It turned out to be a new investment factor, like momentum or growth or value. And they named it. They named it the human capital factor. And Bruce, it's got one very critical difference. If you think about every chart we've ever seen about showing value and growth investment factors, they kind of oscillate above and below market performance. If you look at the human capital factor for the last 17 years, every year it is outperforming the market by 3 to 6%, which is really quite astonishing. And perhaps the most important element about the human capital factor is we do not use any financial performance to choose those companies. It is exclusively driven based upon employee sentiment data. I know we're going to talk more about that, Bruce, but that's the headline, that fundamentally treating your people well now has independently verified statistical evidence that it will lead to outperformance in the equity markets.
And we're going to hear more from Martin about that in a second. I want to add, folks, and you're going to tell us also that their work has been independently validated by JP Morgan's quantitative analytics group. They have not been paid to do so. They have done so on their own accord. And I believe for the last 5 years, your claims have been independently validated. Now, folks, I want to remind you that very few hedge funds outperform their market benchmarks. Frankly, Warren Buffett has told everybody, put your money in ETFs like Just Capital. So, Martin, tell us about what you folks set out to prove and how in terms of the value of stakeholder commitment to an organization's purpose.
Thanks, Bruce. Great to be here. Just echo the comments of my fellow panelists here. We are 10 years old. We're a nonprofit, Just Capital. The whole idea is to try and get business inspired to do more to tackle major societal challenges. And our hope when we started it was that those businesses that did the great job of that would also outperform in the markets, and the data has proven that to be true. We essentially poll and survey ordinary, everyday Americans all around the country every year on what issues matter. I can tell you that worker-related issues matter most, and compensation issues in particular. I can walk you through that, and you know this, Bruce, but the worker-related criteria are always, the dominant kind of weighting in our model, because that's what people care about the most. We then track, measure, and rank the largest 1,000 publicly traded companies in America on all those criteria, and then we celebrate leadership, showcase who those companies are. We just released our 2025 Just 100 yesterday. Paul was on CNBC Squawk Box talking about that. Number one company is Hewlett Packard Enterprise. They're number one in many categories, including many worker categories. We can talk about that if you like. But the bottom line, in terms of the question you asked me, was our flagship index, which is the top companies in every industry, has outperformed the Russell benchmark by about 10% now. And that's on live trading. That goes way back 8 years. The Just 100 has beaten its Russell benchmark by somewhere in the region of 40%. And if you just take the top 10% versus the bottom 10% of companies by industry, then, in other words, you're not taking any industry bets, you're just taking the top decile, bottom decile. The spread there is now 90%. And most of that alpha comes from this sort of value source that Bart just referenced. And by the way, full disclosure, Dan Ariely is one of our board members as well. So we got a lot in common. But that's the punchline. This is like, the takeaway is what is great for America in terms of companies investing in stakeholders, is great for shareholders, and is great for the companies themselves. So there's a win-win-win.
And we're going to now drill down into some more details here, folks, because we have plenty of time today to really get into, from Solange, more of the how. From Bart, we're going to really discuss the human capital factor, because I believe, Bart, and maybe this session is kind of be proof of that you folks are really providing a roadmap. You've identified the elements that human resources should focus on if they wish to get that desired impact. And as I think, Solange, now moving to you, doesn't really start at the end? It doesn't start with human resources. It really starts with the CEO and the board, doesn't it? Human resources cannot fully engage all of the stakeholders in a common purpose, goal, and objectives if every day the CEO is undercutting them by really focusing on extracting value rather than creating value. What's the role of the CEO?
Well, human capital is a governance issue. It's a governance issue for two reasons. One is most companies spend more on human capital than any other part of their business model. So if you look at the line item expenses, HR, salary, wages, programs around people, for most organizations is more than 50% of total operating expense. So it is a governance issue, and it becomes a board and CEO issue when you reframe the concept that human capital is not an expense, but an investment, as the SEC says, in an intangible asset. When you say the word investment, it conjures up this notion of return on investment. And so we now need to rethink, reframe, create a new language around human capital management. And that's why it's imperative for the board and the C-suite to think differently about human capital. They have not only a governance incentive, they have an individual personal incentive. Because if their bonuses, if their reputations, if their personal brands are based on how well the company does, the shortest path to the company's success is through its people. So if you focus on measuring and optimizing the deployment of talent in your organization, you will create sustainable economic value for the stakeholders in the organization, including the employees.
I'm going to ask you a follow-up question on that, Solange, and I know you're so polite, and I've never heard you, publicly criticize anybody, so I won't ask you to. But honestly, how many U.S. companies today are run by CEOs who, if you sit with them next to on first class and they're opening up with a scotch or whatever, she tells you, absolutely, our company is driven by, and not only is it our number one asset, our key metrics are that guides our company. My compensation is based on it, and I make it my job every day to manage by wandering around. How many CEOs today really think that way?
So the first thing is, I don't fly first class anymore, so that's a really nice aspiration. Number two is, if you look at the most recent Conference Board survey of CEOs, they will say that it came out overall that the number two issue for CEOs is around people and people management. So it's high on their mind, but I think there's a disconnect between how they're valuing human capital and how they're able to, I guess, manage that human capital through data, through evidence-based approaches. And it's not unattainable. It's not unreachable. It's just that it's not part of their zeitgeist. So one of the things that I've been practicing for the last 30 some odd years is transforming human capital as a function, as a performance indicator, into financial metrics, financial signals. And everyone has this mindset that HR is this qualitative soft side. You can't really measure it. And what we are able to do through very standard metrics is transform human capital into financial indicators so that you can correlate human capital performance to financial performance. And those metrics, again, are not unreachable, unachievable. We have them outlined in the ISO, the International Standardization Organization Standard 30414. They have been included in academic research for the last 30 years. If you want to go to the conference board and pull down some studies, Martin was part of a couple of studies that we did at the conference board about human capital management. We have 5 standard metrics defined in those resources. So it's not that it can't be done. It's just that it's in leadership's blind spot. Their assumption is, oh, people are people, that's soft side, that's qualitative, and never the twain shall meet between people and financial indicators.
Well, Solange, you coined a phrase that I rip off all the time, and I always say you said it. A lot of CEOs are driving with one eye on the road. And I think the proof of that are the decisions being made around work, a return to work, because the research shows that a blanket approach to that is simply going to drive away your best people. Unless you accommodate them, and then that's a form of DEI, isn't it? Bart.
Well, can I just follow up on that for 1 second? I just published an article, my co-author Stella Lepoucheur and I just published an article in Financier Worldwide in their tech edition that came out in January. And what we did is we costed out the return to work imperative. And what's happening is that CEOs and CFOs see empty real estate and they see that as a sunk cost. And so they're saying, oh, we have to have people occupy this real estate or else we're just wasting money.
Or they're not living up to mandates that they agreed upon with the cities. So there's an underlying thing here, but great point, Solange. Bart, we're going to get back to you on so much here, Solange. Bart, what I'm interested in a little bit, going back, you were part of the B-Lab movement. Which I would argue may have been the first organized attempt in capitalism to reform it. It's still capitalism. We're still all trying to make a profit.
Indeed.
What gave birth to that movement? And how does that relate to these people in HR today? That a whole movement was founded on creating value through people rather than making money by how I can squeeze the consumer, how I can pay my employee as little as possible. Your folks focus on value creation, not extraction. Tell us a little bit how that came about.
Yeah, 100%, Bruce. And so for those in the audience who aren't familiar with B-Lab, it is the nonprofit behind the B Corporation movement. It was I was one of the co-founders about 19 years ago. And at the very center of that idea, Bruce, was that running your business focused on all of your stakeholders and putting your people first isn't just the right thing to do. It's a better way to do business. And the job at B-Lab was to develop a community of leaders whom we certified as B corporations. There are now around 10,000 B corporations in 102 different countries, 150 different industries. The commonality is they're managing their business for all of their stakeholders. And what we did at B-Lab was we tried to collect the data, Bruce, that demonstrated that indeed this made businesses more resilient, that they were able to manage the volatility of markets time and time again over those 19 years, not in spite of their focus on all of their stakeholders and putting their people first, but because of it. And the best data point I had was during the pandemic. During the pandemic, when there are metrics that say between 1 in 3 and 1 in 6 companies failed during small and medium-sized businesses, failed during the global pandemic. Our community of certified B corporations had an attrition rate of just 5%. Now that's factors better. And if you ask those companies, they'd say it's because we put our people first. We were better positioned to survive what was undeniably, a dramatic global economic crisis. And so that's what the B Corp movement was about. And what's interesting about the next work I've been doing at Irrational Capital is now we have statistical evidence that it is directly connected to our performance in the equity markets. And for me, I couldn't find that at B-Lab. I found resilience factors and revenue growth and profitability, but I hadn't been able to connect it all the way through to what, frankly, CEOs and boards care most about, which is equity performance. And we now have that evidence, as you mentioned, independently verified by JP Morgan with 5 research reports.
And we're going to delve more into it because it's so important to human resources management at all levels to understand how what they do creates tangible value. And with the work that Solange does, and I'm not here to advertise anything, but Solange has a terrific book that's in our library on human capital analytics that I certainly recommend everybody. But Martin, I have a question for you. It's funny. I'm not really a sports fan, but you have to be living in New York. You have to follow things, and I'm a history buff, so I follow. I read about wars, and one thing I've always noticed is that the teams and the forces that win are usually those where the people are most engaged, where they are the most inspired, they're the most committed to their purpose, goals, and objectives. They make the best of whatever materials they have. Their supply chains are forced, even if they don't have supply chains, like in Ukraine, they're getting reinforced. The communities support the soldiers. They come home, they're celebrated. Whereas Vietnam, look what happened. And teams, the same thing. Look what, I'm a New Yorker, I shouldn't say it, but Tom Brady, come on, the guy knows how to manage a team. Why is it you think you guys had to create a fund to prove the value of what really is something we all should know about? I'm confused.
Well, we wrote a paper a few years ago on human capital, all the data we had, and we kind of referenced the 30 years of data. I'm just talking in a business context now, that highlighted the value of human capital. And Solange is exactly right. This framing around investing in people, I think is crucial. That's the essential element here. And, in opening, and we had all the data that showed companies that had highly engaged workforces did better, treated people better, invested in people, did better. And I used the old Wall Street joke, which is, if you're walking down Wall Street and you see $10 bill on the floor, nobody will stop to pick it up because it can't be real. Otherwise, somebody else would have picked it up. So I think that's true. I think sometimes the obvious is not. It's hiding in plain sight. This source of value creation, especially today. Look at what percentage of the S&P 5 is due to intangible value. Look at every CEO that I talk to these days. Every CEO stresses the importance of talent, finding talent, keeping talent, investing in talent. That is the differentiating factor. So yeah, I don't know, Bruce, why that is, but I do know that smart business people kind of already know that. I don't know that investors always look at that. If I were to take my own retirement funds and simply invest in companies, and I have invested in the Just ETF, but simply invest in companies that were the best at supporting their talent and getting the best people, I'll hopefully I'll have an early retirement. So yeah, it's there. I think the question is, how do you message it? How do you get it out? What does it look like? Are people listening? And there are none so blind as those that will not see.
Well, we don't probably have time to talk about that, but I'm going to try to get to that. My simple theory is that people don't feel they can change it. You can't fire your CEO. You can fire the president of the United States, and they did, right? But they can't go in and fire their boss, and they can't go out and fire all the other CEOs. I think there's a sense of I can't.
Well, but it is circular though, because if human capital is a source of value, and the CEO is not doing a good job of tapping that, then they're not doing a good job of creating the most amount of value for their company, and that's when CEOs do lose their jobs.
Yep. And again, we're gonna have time thanks to this format. So Solange, I now want to start to drill down a little bit from a practical standpoint. And that will apply to you, Bart. I want to look closer at the human capital factor and what some of the issues, like for instance, appreciation. What was that? And Martin too. I really want to talk to you about this whole interrelationship between stakeholders that Dave Ulrich in HR often talks about. But Solange, to you, what do you think should be if you are an HR person anywhere in the world, Singapore, Malaysia, Ghana, anywhere, what would your key takeaway be from what we're talking about today? What does that mean? Not every person in HR has to be a business leader, right? But is there an opportunity for a new type of HR leader who is in effect a business leader?
Yeah, I think, well, I think understanding the business that you're in as an HR person is an imperative. And in fact, what we've seen since COVID is a lot of turnover in the CHRO role, with more people being put into those roles that have actual business and operating experience. So their backgrounds aren't HR backgrounds, they're business backgrounds. So that tells you something. That's a signal. I think that there are three core elements that good HR people have. The first is human capital intelligence. A great HR leader has a data-driven mindset and is able to take data, analyze data. HR is the only function in the organization that does not use data evidence in their narrative. Even marketing has found a way to calculate an ROI on marketing spend. So we need to create that language in human capital practitioners that include these financial metrics that I indicated before, like HCROI, human capital return on investment, HCVA, human capital value add, HEVA, human economic value add, HCMV, human capital market value. These are all indicators of efficiency and effectiveness of investment in human capital without getting into human capital programs, but looking at the outcome performance. The second is HR people have to integrate their programs, their approach with the business strategy. So the function should have some financial discipline around it, right? So I said before, it's an investment. We have to prove the return on that investment so that we can show value creation for the organization. So it has to be integrated with the business strategy, and we need to understand the business model. What are we in business to do so that we can align our people to support that? And the third is stakeholder-driven value creation. We're not just serving our employees. In fact, what Dave Ulrich would say is HR isn't there for HR. HR is there to support the customer and to support the business in achieving its goals. So, you're the stakeholder capitalism guy. So HR needs to think about how what it's doing serves its stakeholders, including shareholders, customers, investors, strategic business partners, employees, and the community. And that means designing the work environment in a way to enhance retention, productivity, innovation, and to be able to measure that, which is exactly what Irrational Capital has been able to do. Take these, what they call intrinsic indicators, and turn them into a financial or a quantitative measure, an index. And that's what the function needs now. We need to evolve to use the same types of discipline and the same language of business, which is a financial language. We don't speak finance, we speak HR. It's time to speak finance.
Well, and here's, I think, the good news for folks in HR, because the professor of HR once told me that he thinks a lot of people go into HR, Solange, because they don't like business. But guess what? There really is an enormous opportunity for the human touch, even within what Solange is talking about. And we're going to circle back to that.
Absolutely.
So those of you who came into HR for the social work side of it, I actually will argue that that part is being overlooked right now, and there's an enormous opportunity to address that very easily. But Bart, this is a good segue to you. I personally think, after I looked at the human capital factor, and given my age, and I'm older than all of you, okay, and I'm proud of it.
Maybe even put together.
Yeah, maybe. But what I've been hearing about all this stuff since 1989, okay, and very little has really changed, okay. In fact, one might argue that the heyday of American capitalism was in the 1950s, but that's a whole nother story, okay. But the point I am making, Bart, is that you've really gotten into what are those factors. So could you kind of, and so I'm going to start with this crazy question. When I looked at it, this word appreciation stuck out at me, and it's such a warm and fuzzy word. It's almost the door closer at many companies. Tell us about that and the other factors, because folks, those of you in HR, they are your North Stars of where you're going to get a difference. Go ahead.
Yeah.
What are the major factors?
Sure. And so, again, backing up, the work done on our human capital factor is really born from that research by Dan Ariely. And Dan, his research has always shown that when we talk about employee motivation, we measure the wrong things, Bruce. We measure things like pay scale and benefits and vacation time and option plans and bonuses. And what his research was showing is that what really truly drives motivation are intrinsic motivators. Things like, is there trust and transparency across the organization? Do I feel psychologically safe to innovate and try new things? Do I feel recognized by my manager and appreciated, to your point, Bruce? Do I understand how my work is connected to the vision and mission of the organization? These intrinsic motivators drive motivation and therefore performance, and ultimately performance in the equity markets to a much greater degree than how much you pay people. Now, don't get me wrong. You have to have, it's table stakes to make sure that you actually are compensating folks appropriately. But to get to that outperformance, Bruce, they have to have these other intrinsic motivators. And we've broken these down into what we call the 7 dimensions of the human capital factor. 6 out of 7 outperform the equity markets year in, year out. Those are all the intrinsic motivators, things like engagement, or organizational alignment, organizational effectiveness. The single one of the 7 that shows no difference than the benchmark is extrinsic rewards. And so the data is abundantly clear that what matters are these intrinsic motivators. And I really want to bring it to a fine point for the listeners here. So we've taken all this data and this approach through the human capital factor, and we've created 3 ETFs, a large cap, a small cap, and an unconstrained. We call them the Happy Suite. They're HAPI, HAPS, and HAPY. Let's just take a second on HAPI, which is our large cap portfolio. That went live in October of 2022. Since then, it has produced a return of 83%. Okay, 12% above the S&P 500. And Bruce, what's important to know about that analysis is we create that portfolio by making it what's called industry weighted and market cap weighted. The only reason why that matters to your listeners is that it has no incremental risk than the S&P 500. It's the same risk as the S&P 500, but it gives you all of the outperformance of the human capital factor. And what that means is, on a risk-adjusted basis, for the last 2 years, it's in the top 1% compared to 1,400 other ETFs and mutual funds that are benchmarked against the S&P 500. That's remarkable. I mean, it's just remarkable, the fact that that's put together exclusively based upon employee sentiment data.
I want to tell the group here that's listening that he's not hawking these funds, these ETFs. They're actually licensed. This methodology is licensed by Harbor Capital Advisors, and we are not hawking stocks. We're not doing that.
Indeed.
But you have to look at the results from the standpoint of what do CEOs pay attention to, what do shareholders pay attention to. And Martin, this swings me over to you. When our organization founded in 2009, we created a stock index, a mock stock index, an ETF based on the work of Lori Bassi. Oh, I'm sure, Solange, you may know Lori. She leading human capital analytics, and she created a basket of companies that were rated very highly on scores of employee engagement, customer engagement, and community engagement. And over 12 years, that outperformed the S&P 500 by 37.1%. And it wasn't weighted by, like, it didn't have NVIDIA's or the Magnificent Seven. It was only weighted on their scores. So, Martin, what aha went off? I've heard that that it was actually a meeting with Deepak Chopra or whatever, and the founder of your group, that actually inspired this. What inspired this focus on stakeholders? And then, and this I want to play off of what Solange said, is what have you learned about understanding the interrelationships of stakeholders? Because I think many companies are really saddled with silos that hold them back. What is this important? What made you guys start this? And what's the importance of looking at a stakeholder approach for HR?
Well, you're right. Deepak Chopra, essentially, in the sort of 2000 post Occupy Wall Street years, let's say, was really teaching a course at Columbia actually on just marketing, and that kind of expanded to like what is the role of this idea of a just company. So that was the word that he came up with. Took the idea to Paul Tudor Jones, obviously legendary investor and philanthropist. And Paul immediately kind of grasped this belief that as a philanthropist, he felt that the private sector had to do more if we were going to really tackle our biggest challenges. Government philanthropy weren't going to solve those things. You had to get business involved. You had to get business motivated and inspired. But the investor in him also thought, I bet you the companies that do this well will be rewarded in the market. But we didn't know that going in. Paul's insight at the time, this is 2013, 2014, was it's not for me to decide what issues matter. It's not for you, Deepak, or any of our founding board, or for me, Martin, as the founding CEO. Let's turn to the American people and ask them what they think. And for the first time we did that, we didn't know what we were going to get back. In fact, I had a lot of people come to me and say, why are you asking the public? They don't know anything. They don't make any sense. They're not going to give you anything that they don't know about climate change. They don't know about, these issues. So why ask them? Well, actually, we got a lot of common sense back. We got the idea that most people see things as interconnected. To get to your last point, people don't silo things in their daily lives. They tend to see the interconnectedness of the place they live, the place they work, how they feel, how they're treated, how they think about the future, their hopes for the future, their pathways to prosperity. All of that's connected to your health. It's connected to where you live. It's connected to your sense of being and identity. And so we silo things because in business, that's what we like to do. So you can measure them, gather data. But at the end of the day, these are human things that create markets. That's what markets are, right? There's an amalgamation of human sentiment. And so that's really what is at the root of just, and why I think there's such an interconnection between all those different stakeholders, and why ultimately that wisdom is reflected in reward in the marketplace as we first thought a decade ago.
Now, when you first started this, and I'm going to come to you in a minute, Solange, and you started ranking people, and folks, as Martin said, you can see the most admired companies today. And if you're looking for a job or a company to do business with, look, I sometimes like to kid that capitalism is the best shitty solution from the movie Argo, which is why I can say it. But, not every company's perfect. They lay off people. Bad things happen. It's all relative. But look at that list, and I did, Martin. If I were a young person today, those are certainly companies I'd want to work for. But the question that I have for you, moving on from that, Solange, is what do HR people now, from a practical standpoint, have to take away from this? Because to me, more than ever, we need HR to be social workers in a sense. We do need that. My son works for a fantastic stakeholder capitalist company. To keep him safe, I won't tell you who it is, but they're a fabulous company, and they make something that the world needs real badly. And they are treated so well by that company. Do you know, Solange, every 40 days, he gets a call, not from well, they don't use the term HR. He gets a call from a senior person who checks in on him. How are you doing? Do you have financial problems at home? Oh, I hear you had a new kid. Any issues there? Are you concerned about this? Or do you have a worker problem? Every 40 days or so, he gets that call. So isn't it important as we ask HR to act like business strategists? And I want you to, let's address that. What should they be doing in this new world where they don't forget the human touch?
Yeah, and I don't think that we're asking HR to not be empathetic and not be people. But that's the core of the function. People go into HR because they have a calling to it. And the calling is usually something that is interpersonal, that is around emotional intelligence. And that's fine. And we should have those kinds of people. But we need a different type of skill set, which is exactly what I focus on in my work at Columbia. In the courses that I design and deliver, what I'm trying to do is focus on the future, right? The skill sets that HR people need. And I don't like to call it HR, I like to call it human capital, that human capital people need in the future. And in my opinion, there are 4 fundamental things that HC people need to be successful in the future, on top of those human skills that they bring to the organization. First is data fluency. They have to understand analytics. And they don't have to be an analytics person. They could have an HR analyst or an HC analyst on their staff, but they should understand not only the trends in their organizations through data, but the competitiveness, their competitive position against others in terms of those trends. Financial literacy is key. Maybe I should have put that number 1. Since the language of business is a financial language, HR needs to start speaking a financial language. So HR people need to be able to articulate the ROI of talent investments in the same way that a CFO discusses capital investments. They need to be technology savvy. They need to be able to use AI, automation, workforce planning to be able to increase the precision and the efficacy of the programs that they're designing and implementing in the organization. So not only should they be using AI as a tool, they should be thinking about how they can embed AI in jobs, right? So that has 2 pieces to it. And the 4th is they need to be change leaders. So they need to drive culture and operational shifts to align talent to business strategies and measure those programs, those outcomes to sustainable financial performance of the organization. We have to not just think about HR in terms of HR metrics, but HR in terms of business metrics, financial metrics.
Folks, we're going to lose Martin. He has to sign off. Martin, thank you so much. I was going to ask you a zinger question, so you got away just in time. Just kidding.
Thanks, everybody. It's great to be here. Bruce, really appreciate it.
Thank you.
Take care. Bye-bye.
Appreciate your work.
Good to see you, Martin.
So in any case, that gives us a little bit more time to address what I wanted to ask you, Bart. But to finish up, Solange, I think that the really important part of all of this is to really say to HR, this is an opportunity to earn a boatload more money. This is an opportunity to really elevate the profession because, and this is my segue to you, Bart, when you are able to show to your CEO tangible evidence of value creation, what did it, that recognition program didn't just cost money because we had a nice little computer thing. No, it was part of a strategy that was aimed at improving productivity, quality, service levels, customer retention. Yes, customer retention. Then all of a sudden you have a seat at the table. So Bart, let me ask you this. Was that kind of your intent when you guys, when you started B Lab? We don't have time to get into all your motivations for that, but you're, getting involved with your Rational Capital. Was part of this to really show to CEOs and the investment community, to Solange's word, we're driving with one eye on the road?
Yeah. So, Bruce, my suspicion, I think the founder's suspicion at B Lab 20 years ago was exactly that. And it was the evidence we had firsthand from businesses we ran previously. I ran an athletic footwear company for 11 years called And1 Basketball. And in those 11 years, I saw time and time again that putting your people first, whether it be your own employees, your customers, your relationships with either retailers or your supply chain, it paid for itself over and over and over again. And the quick story there, Bruce, is the company that we sold And1 to didn't share those values. And the company collapsed. It collapsed. It went from 250 million to 40 million in 3 years' time. And coming out of that, the idea, the seed idea around B Lab was indeed, this is a better way to do business, and we need to prove that at scale. And so we work with 10,000 certified B corporations, but there are 400,000 companies that use the tools of B Lab to be more like a B corporation and embed these values in those businesses. And the reason why Irrational Capital for me is a beautiful capstone to that career of first being an entrepreneur and then being a nonprofit leader is I can now make it very tangible financially. And it changes the conversation you have in the boardrooms and with the C-suite when you can point to statistical evidence, not from Irrational Capital, but from JP Morgan, that this is indeed a better way to do business. And so my hope, Bruce, is that if we can prove this at scale and drive it, it'll lead to corporate behavior change. And it should be a win-win-win, right? Everyone should win here. And so I do think it's really important. I know we're appropriately hammering the financial benefits, but those financial benefits are from those intrinsic motivators. It is the core of the HR function. You need to add the literacy of how you connect it across to something like stock performance. And that connection, every time you walk into the boardroom and you only get 15 minutes, if you walk in with evidence that it drives outperformance in the equity markets, trust me, you're going to get a lot closer to an hour in the boardroom.
Yeah.
And it's just really important.
And we're going to finish with you, Solange, with 3 minutes. Or 2 minutes, Bart. So let me ask you this, Solange. The whole focus on value creation, in my view, had the diversity, equity, and inclusion movement focus on value creation rather than on social equity, which is a real issue. It's very important. But most businesses aren't started to solve racial inequality. We are started to maximize performance for our shareholders and ourselves. So to me, if we had a value creation to DEI, wouldn't it have looked an awful lot different? And maybe right now we wouldn't be in the backlash that we are against what really were a bunch of cockamamie ideas, in my view.
Okay, I'm not going to address your opinion about DEI being a cockamamie idea.
No, I didn't say that the way it was addressed.
Okay.
Go ahead.
Okay.
You have the last minute.
And this is what I said before. We cannot do HR programs just for HR. We have to connect what we're doing in HR to business outcomes. We analyzed about 180 publicly traded companies that disclose their diversity information. And what we found is that when diversity went up, it correlated to higher HCROI, and HCROI is a precursor to profitability. So a couple of things. One is when your employee population is diverse, you get more creativity, you get more ideas, you get more cognitive things going on, and your employee population mirrors your customer population. Okay. So you get closer to your customer. When you get closer to your customer will like your products better. So even if you don't look at the numbers, if you just think through the logic, it works. So I think that if we would have connected DEI to financial outcomes from the onset, we probably wouldn't have been in this problem. And two little things. One is we wrote a paper about this at the conference board. So if you go to the conference board, it's available to the public, and it's about the new role of the chief diversity officer. So you can look at that. And I just published something. I have a column in Forbes, and I just published something that said, and I did some analysis, that in the last 10 years with DEI initiatives, white men have benefited from these programs as well. It's not at the expense of white men. White men benefited from DEI initiatives. So if people would just look at the data, they wouldn't make stupid decisions about eliminating programs that actually support their business outcomes. Because it's not about business outcomes, it's about politics. And
and that's when trouble happens. And we could talk about this all day and violently agree. But we're out of time. I want to thank both of you, Bart Houlihan, whose work at Harbor. Well, I should say you should check out the products of his work at Harbor Advisors, but they are an independent research company that does not manage investments themselves. Solange, her books, just check her out. She's a great resource for all of this. And obviously, Martin Whitaker of Just Capital, check out their work. And I think the number one lesson, folks, is that when HR really focus on value creation, the opportunities are enormous, because Solange, is another acquaintance of ours, says people are the last bastion of value creation in business. That's my last word. Thank you so much.
Thank you.
Thank you.